Welcome to the Hotel Guesthouse Valuation and Financial Model for 20 years. Valuations of hotels should not be a problem with the correct model. Let us take you directly to the index of this model. You will note an input sheet, valuation, cash flow statements for 20 years, income statements, balance sheets, and brief explanations. If we have a look at the explanations, we'll just go through briefly the potential capital gains tax implications, net present value, internal rate of return and modified internal rate of return, the differences thereof, and PE ratio for hotels instead of cap rates. So we can go directly to back to the input sheet, the index, shall I say, and onto the input sheet. Now this model is extremely coherent and simple to use. You'll see the basic income projections for the rental suites, room rates. You can have the sizes, or the types, the sizes, the number of units in each size category, the average daily rate, the monthly occupancy average percentage, and it will calculate the income per month that you will generate out of these particular suites. Your other income generated, very important. You should pick this up of any balance sheet that you're working on or data that is available for you. The basic types of other income are from restaurants. You might have 1, 2, or 3 restaurants within the hotel group or guest house lodge. Your bar facilities and what you are generating, laundry services, storage fees, banqueting hall, private meeting spaces, etc. Those are all other incomes that you will generate over and above your room rates. You simply will input your average gross profit and your turnovers, etc., and it will generate everything else for you. Your cost of goods amount as well as your GP amount. Your projected or annual monthly expenditure are the typical rates and taxes, levies, utilities, insurance, maintenance, etc. You've got cleaning, all salary staff, security staff, and there's some further input fields if you feel there are other types of expenses which you should bring into play. Your purchase or acquisition data, we would apply a market-related price to earnings ratio figure, and in this instance, for this model, we've got 9. You can change it to whatever is deemed appropriate. And your acquisition fees, which would be your attorney's fees or transfer costs or whatever else you might have to pay to get the property into your name. This has been automated for you. It's your incomes after vacancy, your op costs, and your net income before taxes will equate to a valuation based on this price earnings ratio. And then we have annual escalations, your weighted average annual cost escalations, your annual income escalations going forward, expected growth in value going forward. This will normally mirror your growth in income. And then the finance data, you will enter the external loan amount which you would require from your funders, finance rate length of months, and that's your repayment monthly. Your income tax percentage, capital gains tax percentage, and the cost of the owner's loan account, because bearing in mind no funding is free. So the difference between your finance amount and the actual valuation that you're paying will automatically accrue to your owner's loan account. So from here, we can go and look at your valuations and what it means to you. This is the data carried forward from your input sheet for your convenience, so you can see exactly what's there. We've got net present value, internal rate of return, and modified internal rate of return from 5 to 20 years. So you can see immediately see the performance of that particular hotel or guest house with that particular valuation, which all data you can change by just going back to the input sheet. You've got your earnings before interest and tax, loan to value ratio, net profit after tax percentage. It's interesting to note, in this particular model, your loan to value ratio eventually achieves a minus 25%. That is because you're carrying quite a large cash pool in your balance sheet. Is just a visual of the visual numbers of your original valuation, your current, your capital gains, and the capital gains tax liability, which becomes very important when we calculate your exit values, which in turn goes into the internal rate of return, etc. And just a brief graphs for your convenience: the capital gains tax versus your capital gains tax liability, loan to value ratio, etc. So you've got a little bit of a visual on the valuation itself. You have 20 years of cash flow statements. Detailed cash flow statements will show you what the owner's loan capital received was, your external loan financing received, your capex of your building, acquisition fees, cost of goods sold, etc., all running through. So you are able to view your exact cash position on this valuation model year by year for 20 years. Your taxation has been computed from your income statement. It's all available in here as well. Your income statement, much the same. It's a 20-year detailed income statement, clearly displaying your interest on your external loan as the years go by. Your interest on your loan account, which is static, there's one amount loaned to the business or hotel. Your net profit after tax, and in the first year you've got an accrued loss, so there's no taxation in this model. Anything, as I say, it can be changed. If we go back to the inputs and we put a price earnings ratio of 8.5, for example, it would follow through to your valuation. It would follow through to your necessary cash flows, income statements, etc. Then you got your 20-year balance sheets. The important aspects here are your original valuation, the revaluation reserve account, and your capital gains tax obligation if you exit the investment. So the revaluation comes from your input sheet on the growth of earnings that you've predicted, and the revaluation at a percentage that you've also predicted. And as I say, you've got your capital gains tax liability all neatly placed here in the event of exiting the investment. And needless to mention that it all gets accrued into your internal rate of return and modified internal rate of returns. You just for checking that no undue figures are there, this should always be zero. Your balance sheet, and then we've got a tax computation for your convenience, because quite often one is running a loss in the income statement, in year one or two, and it is difficult to follow why tax isn't paid in year three when there's a profit. So all you have to do is come to the tax computation. It's all neatly placed for you. At this point, as I say, the valuations should not be difficult for hotels. They follow a coherent manner. Everybody is interested in internal rate of return, modified internal rate of return. If your valuation is incorrect, in other words, if the price asked is too high and your price earnings ratio is incorrect, etc., you alter it and you get to the price or the value that you should be paying to make this hotel or guest house investment coherent. So this is all you should need, even if you're approaching the bankers or outside investors. You should need no more than this as a comprehensive valuation, which anybody can follow, and there are no difficult or tricky formulas in the model whatsoever. Thank you for watching this model, and please watch some of ours.